Hello everyone and welcome back to Raise Your Wealth. In today's episode of the ASX ETF Profile Series, we're going to be taking a look at the Betashares NASDAQ 100 ETF, better known by its ticker symbol of NDQ. NDQ is without a shadow of a doubt one of the most popular choices for Australian investors seeking international growth-based ETFs. Given its past growth and its performance amid an extremely arduous period for many industries, NDQ has been a testament to the resilience and strength of its underlying holdings. The NASDAQ 100 index that NDQ seeks to emulate is home to some of the world's largest companies, entities that have been instrumental not only in shaping the past few decades, but perhaps the decades yet to come. So let's take a moment to look at what the NASDAQ 100 is and why it has undergone such enormous growth. That way, you can make a more informed decision about what you're investing in and whether the product is suitable for you. The NASDAQ 100 index comprises of 100 of the largest US and international non-financial companies present on the NASDAQ exchange in the United States. Around 50% of the index is weighted into technology companies, with the remaining weighting being comprised of consumer discretionary, communication, healthcare, with a smaller allocation into other sectors. I will put on the screen for you now the top 10 holdings of the NASDAQ 100 so you can see which companies are in it. Looking at it right now, you probably see some very familiar names: Amazon, Google, Facebook, Microsoft. You've probably heard of these companies before, and they lead the index and make up the lion's share. These companies started as minor obscurities, and they have blossomed into entities of unimaginable scale and reach, spreading globally and changing the way in which we live. The proliferation of the internet, the rise of the smartphone, and the use of social media are a few innovations that have changed the way in which we interact. These companies are among the world's most innovative and diverse. So let's take a look at some of the prominent holdings within the NASDAQ 100. Amazon, for instance, which started in 1994 as an online bookseller, has now blossomed forth into become the world's largest retailer. In addition to its retail revenue, it gets additional sources of revenue from AWS, which is a cloud computing service, Twitch, which is a streaming service, and Whole Foods. Apple is another one of these tech giants, with global reach in consumer smartphones, as well as other devices such as the Apple Watch and AirPods. The company also derives revenue from digital content, such as Apple TV and Apple Music, in addition to Apple's own cloud services. Taking a step out of the top 10 is a favorite of mine, Activision Blizzard. A global entertainment and video game giant, it is responsible for franchises such as World of Warcraft, StarCraft, Call of Duty, and Overwatch, among others. It generates revenue through not only game sales, but subscription-based services, esports leagues, and the sale of in-game items through the Blizzard store. From just these few examples, we can see that this is an index of innovative companies that are emphasizing growth on a global scale and pushing technological implementation in many facets of our life, from shopping to entertainment. Now that we know what NDQ invests in, let's take a look at some of the key facts of this ETF that I will place on the screen for you now. The issuer is Betashares. They are the one who will buy all the individual companies at the proportions needed to emulate the performance of the NASDAQ 100. And they will issue units in an open-ended way depending on demand. The net assets of this fund are close to $1.5 billion, which means there is very, very, very little chance of this ETF being closed down. It has a management cost of 0.48%, so it's not the cheapest. It's not as cheap as something like VAS, but for a niche fund, it's about what you would expect, but given its performance, it's pretty acceptable. It has a dividend yield of around 2.5% presently, which is surprising considering that it's mostly a capital growth-based ETF, but it still does push out a reasonable dividend. And that dividend is paid twice a year in a bi-yearly fashion, and dividend reinvestment is available. In order to register for that, you go through Link Market Services, and a lot of people who are accumulating wealth will probably want to do that just to get the multiplicative growth that comes from reinvesting dividends. Of note, there's also a hedged version of this particular ETF called HNDQ. The regular NDQ is unhedged, so it is subject to currency fluctuations. If the Australian dollar falls in value relative to the US dollar, the fund will outperform. If the Australian dollar rises, then the fund will underperform relative to the index. The hedged version basically does the opposite of that, and if you technically wanted to negate the effect of currency fluctuations, you could have a mix of 50-50 NDQ and HNDQ, but for most people it'll be just easier to hold NDQ, and currency fluctuations are not going to be a big deal to most people. Now that we've looked at some of the key facts, let's get to the juicy bit, the performance. And NDQ's average performance since inception has been 21.4% per annum. This is after fees and assuming a dividend reinvestment. This is far in excess of the S&P 500, which averages around 9 to 10% per year. In fact, in recent years, the majority of the growth of the S&P 500 has come from the tech constituents that top the NASDAQ 100. In a sense, NDQ concentrates its investments in the fastest growing companies without being held back by other legacy holdings that are struggling and declining right now. Of course, as with anything, there are generic investment risks of concentrating on one sector. In early 2000s, tech underwent quite a contraction on the back of a massive tech bubble that formed in the late 90s when the internet was just taking off. So that's obviously a risk to be aware of, although the constituents of the NASDAQ 100 are, for the most part, very real companies making very real products and services, compared to the late 90s bubble where everything with a .com in front of it was given ridiculous valuations. But it is what it is, and I will now move on to my final thoughts on this matter. For someone seeking a growth-based ETF, this is certainly worth some consideration. Especially for those who are younger and have a higher risk tolerance, this may be a superior option to something like the S&P 500 fund. NDQ is currently the only ETF on the ASX to invest in the NASDAQ 100. Thang is similar, but it is different, and it has only 10 holdings and thus less diversified, although very, very similar to this one. Given that Australia basically has no tech industry of note, sorry Afterpay, this ETF can serve as an effective diversification. There is very little correlation between the ASX and the NDQ, and it is my opinion that NDQ's constituent holdings will continue to prosper in the coming decades. Short of some war or other cataclysm that regresses humanity's technological progress, the growing trends towards automation and AI means that many traditional industries may be supplanted by tech-based replacements. The recent lockdown has highlighted firsthand with activities like schooling, work, and shopping increasingly moving online. But those are just my thoughts anyway. Let me know what you think about these trends and whether you believe that tech is indeed the future and these gargantuan companies like Amazon and Google are going to continue their dominance and continue to grow. But with all that said though, if you found this video useful and informative, please drop it a like and subscribe. And if you want to see more content like this, please stay tuned. I have many more videos on the way. But with that said, my name is Rich, and I will catch you guys in the next one.